Today on BPN Insights with Chip Kispert, the most underutilized growth lever in the wealth management business, philanthropy. Chip, take it away.
RJ, thank you. Well, welcome to the BPN Insights podcast. Our guest today is Lou Daddario. Lou and I go way back, and I've finally got him on the mic. So Lou is CRO for Foundation Source, and today he's going to change the way you think about charitable giving. Lou, great to have you on.
Oh, thanks for having me, Chip. I appreciate it.
We're going to cover today a couple different topics. We're going to look at why private foundations are one of the most overlooked tools in an advisor's playbook. Additionally, we're going to talk a little bit about what the data says about how the ultra affluent actually want to give and what they're not being told. And then we'll get into some discussion on explaining the different types of philanthropy out there, and Lou will give us some great insight on that. So how about we just start from the base, Lou? Give me your backstory, right? I know what your backstory, but I don't know that our listeners do.
No, well, thanks, Chip. So yeah, I mean, as you know, I've been in the wealth management, wealth technology business for longer than you or I probably would ever really like to admit. But I centered most of my career around building sales teams and selling financial technology products that cater to advisors, really allowing clients to amass wealth for their clients. And now I'm the Chief Revenue Officer here at Foundation Source. So it's a bit of a change in pace from your trading platforms, your performance measurement platforms, and your typical turnkey asset management programs to really focusing on what turns out is just another really underserved and under-known space within wealth management services. So it's different.
Yeah, it is a little different. And, just listening again to kind of your background, I'm like, he's really a Renaissance man when it comes to wealth management.
As long as you say it, Kevin.
So let's get right into it. Let's have a couple, I want to dive into Foundation Source publishes real data on how private foundations behave. What does it tell us about what high net worth clients actually want from their philanthropy, and how far short are advisors falling?
Yeah, Chip, about 2.5 years ago, I got approached to look at this business, and I really didn't know anything about philanthropy. I grew up a very average kid, and we like to help people and give money where we could, but philanthropy is not a very known topic, and people who even do come into money or have money don't really know what are the options to give money away other than going to church or doing something like that. And as they start getting more wealth and want to start leaving legacy and building legacy and really starting to help in a meaningful way, they're really looking to their advisors to really point them in some direction. And that's really not happening. Today it's people want to be known for their legacy. They want to be known for bringing their family into it. It's really more about doing good than it is about the tax breaks. Most people think that it's, philanthropy is all about finding the tax breaks, looking for ways to shelter money. But if you really talk to most people, only 10% of high net worth individuals actually reference tax as their primary motivator for opening a private foundation or doing something philanthropic like a donor advised fund. So it's really about the desire to give back. I would say one of the bigger changes that is really coming about now is people are moving away from, what we would call checkbook philanthropy, writing a check once and being done. Now it's more about creating philanthropic programs for themselves. And it's wanting to now have that impact be measured. So it's not only about the legacy, it's really making sure that that money is being put to really good use and it's getting the most impact into the world that it need, that they want it to have. And that's really where, advisors are kind of falling short.
Yeah, it's fascinating to me. We actually use one of your products for some charitable work we do within our firm. And I had this big misconception, right? And this is going to be so hard. I think it took me 15 minutes to set up. It was super easy, right? So, getting over that initial hump, I think is a big deal. But what it is amazing when I see, the different types of foundations and how they spend and what they're looking to get out of it. Additionally, I was blown away when I did some research on before this meeting, and just the amount of annual charitable giving is unbelievable.
Yeah, it's up to, I believe, $592 billion now.
Yeah, and the number I had was 557, so I can see that absolutely that growth. The other thing I found fascinating, how individuals are driving a lot of that growth.
Yes.
Which leads me into the next question, and that is, when we look at advisors and their practices, how do you see most advisors using your types of services?
So, you know what, Chip? 81% of wealthy people want to engage with their advisors about philanthropy. And only 33% of those people say that their advisors actually engage. Now, it is mostly because advisors are not comfortable talking to people about things that they themselves are not experts in. So advisors tend to stick to the technical side of it. Wealth accumulation, meeting financial goals, beating benchmarks and performance. But they're really not getting to the client's personal side. What is their goal? Is that to be, known as a philanthropic individual? Is it something else? It's really, what are their personal goals? What makes them tick? Now, the advisors that are more well-versed in philanthropy, that's where they're starting to make some really nice impact, because now they're working with those clients and they're introducing them to the different philanthropic vehicles that are out there. There are private foundations, and one of the biggest misconceptions is that a private foundation is only for the ultra wealthy. The vast majority of foundations are sub $1 million. So now, don't get me wrong, it's certainly not the everyday investor's product, but that's why there's other vehicles like donor advised funds, which can be used, on our platform. You can open up a donor advised fund with $50. So philanthropy and giving shouldn't only be a wealthy person's game. It's just making all of those tools, those products available for people to use in an easy way. Until I got involved in this, I had no idea how to open a foundation or a donor advised fund, or what a fiscal sponsorship was and what the differences in those products were. So a lot of it's about education, and that is really what we're looking to do. We're really looking to get tools in the advisor's hand that they can learn. First and foremost is education. We won an award based on our advisor education program, because we know the biggest barrier to philanthropy is people just knowing what it is and how to do it.
Right. As a sidebar to that, with advisors, you getting into philanthropy and for their customers, there's always been a assets out the back door problem, right? And you know this as well as anybody. So does this help in supporting kind of next gen engagement for these advisors as well?
So it's funny you said that, Chip. Yes, advisors in general sometimes shy away from philanthropy because it's giving money away. It's less AUM in their eyes. However, what they fail to realize is 90% of their clients are donors. The difference is the products that they're using to donate are not under that advisor's book because that advisor never learned the products or doesn't manage those types of products. So, for example, our advisors are managing the assets of the foundations, which, as we talked about in numbers wise, they're not small accounts. They're far bigger than your average SMA or individual account. Donor advised funds. Our platform allows the advisor to manage every dollar on that donor advised fund. So it's not only an opportunity to actually build AUM, but again, it's back to what is making people, your first question was, what do people want out of philanthropy? And it is getting their family involved. So as the assets are starting to transfer down to those younger generations, these advisors are missing the opportunity to not only engage in a meaningful personal way that really gets them to connect with their client, but now allows them to build a connection with that younger generation that typically doesn't necessarily want to work with an advisor. They prefer to do it all online. So now it's making those intros and giving them the tools to manage philanthropy online with that advisor.
You know, it's interesting because a spin-off statistic is that roughly 80% of beneficiaries take their assets someplace else.
Yeah, that is very true.
That's a huge number, and basically with them growing, advisors growing organically at aggressively 2 to 3% a year, that's a big off, that just can help them keep those assets. So,
it's funny, Chip. Yeah, everyone, when the Robin Hoods and the Robos and those alike came along, everyone said the robo advisor is never going to survive. And now they weren't fully wrong. The robo advisor in its form at that time wasn't. People still need someone to talk to once they accumulate enough wealth. But what Robinhood and with those firms are doing is they're getting into those younger generations. They're helping them grow their wealth. And once they get settled in, the likelihood that they leave Robinhood to go somewhere else isn't big. So now you're going to see at some point big assets going into those platforms. And that's where, I think having the relationships with those younger generations can really help potentially hold on to those assets.
Yeah, I absolutely agree with you. And, Robinhood and Trade PMR just came out with their advisor referral for a lot of those single accounts that are in the Robinhood framework. So you are spot on. Now, listen, I need your help, right? So as you said, people can get intimidated by really the tools that are out there. Can you walk us through, in the next few minutes, a 101 on the different types of tools that you guys support and those that support charitable giving?
Yeah, absolutely. So, as I said, we're really building that one-stop shop place where you can pretty much, get all of your charitable needs, under one roof. But like you said, Chip, a lot of people just don't understand what the options are and why people use different things. So it really comes down to, it's really very, very simple. First and foremost, private foundation. There's a lot of benefits to it. You have huge advantages and control over where your money goes. You can give to an individual, or if there's, a mass flood event, wildfires, whatever it might be, you can choose to give to individuals through what we call an applications and outcomes platform. So you can give grants through that. You can hold really complex assets. So, we have clients that have giant pieces of real estate. We have one client that has a camp that they run for the scouts, and the income from that camp all goes back into the foundation. So the camp is an asset of the foundation. The camp generates revenue for the foundation, which allows it to sustain. So it comes down to what your goals are, what is going to be held within that instrument, and a lot of it's what kind of legacy do you want to leave? Do you want your name all over it? Do you want to be anonymous? And when it comes to things like that, that's where donor advised funds are really good. You have less control because once you give the asset to that DAF, to that charity, it is now their asset. It is no longer yours. So you don't have control over what's held and things of that nature. And you can advise them on where you want to give the money, but they don't necessarily have to give it to the exact charity that you want them to, or to the exact cause that you want them to. So that is, some of it. And then it comes down to taxes. Foundations have different tax advantages than a donor advised fund. So cash, for example, donor advised funds have a much better tax benefit than a foundation. So in a lot of cases, it may not be one or the other. It may be both. Both might be the answer. So we call it a sidecar DAF. So a lot of our foundation clients are now opening up donor advised funds with us as well, because it allows them to take different tax benefits. It also allows them to, if they're not meeting their minimum distribution requirement, it now allows them to give to the DAF and at least put it there until they know what they want to spend, but then they don't end up getting the penalties from the government for not meeting their minimum distribution requirement. So a lot of times it's not one or the other. It is both.
So one other kind of sidebar to that, especially as I held a compliance roundtable a week ago, how does compliance feel about this? What's the interaction with compliance?
Compliance struggles a little bit because, as you know, when it comes to investment policy statements and things of that nature, when you give it to a DAF, well, it's the charity's assets. So they don't necessarily have to sign an investment policy statement because they have their own investment policy statements that they adhere to. Also, in giving tax advice and things of that nature, a lot of advisors really aren't equipped to know what the nuances of the different tax regulations are and what the different nuances and rules are with a private foundation and expenses and things of that nature versus just giving to a DAF. So, compliance is starting to catch up, but that is also why people hire firms like us, because it is a very nuanced niche business that even most CPAs will admit to their clients, I know what the basics are, but you really should go to somebody who really understands the intricacies and the rules behind that because it's different.
Lou, help me with one thing here. Let's focus on the advisors, right? And some of the benefits that they get out of it. We talked about, the benefit of getting to the younger generation, but advisors that really put philanthropy into their business model, what happens with their practices? What's your observation been?
I could say the advisors that we have seen shifting their businesses more to a philanthropic practice have extremely sticky assets. You're now working with people on a different level. It's no longer about the money. It's about the relationship. And Chip, you buy things all the time, right? You buy things from people you like and people you trust. So I think once they gain that trust and that relationship, those assets become sticky. It becomes a lot less about performance. It becomes a lot less about everything. It really becomes about, I like Chip, so I'm going to keep my money with Chip. And you know what? I'm going to tell my kids they should keep their money with Chip because Chip's trustworthy and Chip's helping our family do good. And on the other side of it, those advisors also feel better about themselves. They're not pushing just product. They are actually making a meaningful change to other people's lives beyond their client. Their client's success and the success they've helped their client achieve is now trickling down into areas of the world that it normally wouldn't have. And a lot of that is being driven just by the markets. Markets are down, which means typically governments tend to shut down and restrict assets and money flow. So, what used to be a lot of programs that relied on the government are now relying on private philanthropy. So those advisors that stay astute and aware of that, they're the ones that are going to be successful. But to do that, you really have to implement platforms and systems, just like your trading and your asset management business. You can't run those businesses without trading tools, without reporting tools. You need all of that to switch gears into running a more philanthropic platform.
Lou, question for you, right? Like me, you've been in the industry for a minute. When you look back, right, where is philanthropy versus some of the past new things that have come down the table or come down the pipe?
Sure. Well, Chip, you go to as many conferences as I do, and it's back in the day it was about UMAs. They were the new hot dot. It was about MSAs, SMAs, and all the other acronyms that you could think of. But how many times have you been to a conference where main stage was someone talking about philanthropic solutions and how they could benefit your client, your practice? It goes back to that advisor education piece. Everything advisors attend, philanthropy is not really mentioned. They're learning about financial products, not necessarily about this.
That's a great point. Absolutely a fabulous point. I'm going to shift completely to a different subject here. And that is, I always love to hear about who you admire within our industry. And that can be people, that can be firms. I'm really curious about a couple people that you follow.
Yeah. I mentioned one already. I have a lot of respect for what the Robinhood and Trade PMR guys are doing. I think they took a segment of the market that frankly nobody wanted. Nobody wanted $1,000 SMA account. And they took that, they serviced that group of people, which there's a lot of them. And now those accounts, their average account size continues to grow and grow and grow. And they're offering more and more services away from just kind of that basket of securities to, offering real investment advice, things that is largely powered by AI and other things that are coming down the pike. I look at like Morgan Stanley and JP Morgan. Everyone says the wirehouses are dead. Not really. If you look at the actual growth dollars, not percentage based, of course, a $1 billion firm, if they grow to $2 billion, wow, 100% growth. But on a dollar for dollar basis, you look at the things that JP Morgan and Morgan Stanley are doing, they're servicing their clients with everything from philanthropy to asset management to banking to retirement. So, I look at them and I see them doing some pretty good things.
That's fascinating. I love, you actually hit two different areas there. With Robinhood and Trade PMR, really their tech influence is a big deal in what they do, and they have democratized investing quite well. And then I can't tell you how many times I've heard the wirehouses are dead over my career, and they are certainly not. My sister-in-law actually is a advisor with one of those wirehouses, and they do a great job. They do a great job for their customers. So, all right, we're jumping into the final here. I like to give you 60 to 90 seconds to share with us BPN Insights, all right? And no scripts, no safety net. I would love to hear something that you're thinking about, future of philanthropy, the industry, either of those, the floor is yours.
Sure. Well, I'm sure every single person that you have on this podcast says probably the same thing. I think AI truly is going to be one of the biggest drivers of frankly success of our business. I think where we talked about advisors just not feeling comfortable talking about philanthropy, for example, the AI agents, they know it. They're more than comfortable to propose it. So, I think there's areas like that where I don't think an advisor is ever going to go away, nor do I ever think an advisor should. I think the advisor plays a massively important role, But I think the advisor having the tools with AI to be able to surface new ideas, crunch through that data way faster and frankly better than any of us humans really can, I think that's really going to be a game changer. And I think that's really what is going to drive not only philanthropy, but it's also going to drive the way that the whole financial services business operates going forward.
100% agree with you. 100% agree. Great thoughts. So, Lou, for advisors who kind of had an aha moment or, wealth firms and want to bring this into their practice, where do they find you?
They could find us on the web. They could find me on LinkedIn. They could find me on your network of providers.
That's correct.
But no, one thing I'm very proud of with Foundation Source is we have an enormous amount of free information on our website. Things like pieces on the advantages of a donor-advised fund versus a foundation and vice versa. Why advisors should think about philanthropy within their practices. We don't charge a thing for it. We want people to get familiar with philanthropy because at the end of the day, it is all about changing the world, and we're trying to do our part.
Lou, thank you for being on the BPN Insights podcast. Really enjoyed having you.
Thanks for having me, Chip. I appreciate it. Always good to see you.
RJ, that was a fun call with Lou.
You hit a topic that really was something I never really thought of. Charitable giving for me has always been a place that I, is important to me or to my wife, and a tax write-off. That's basically how I looked at it. And it's probably wrong, but I want to say the intention is good to support the charity. The tax write-off is something, that's a benefit for me.
That's right. Well, it's interesting because in my mind, I really have three takeaways from our conversation with Lou. And a couple I hadn't really thought about before, but I look at number one is that advisors that incorporate philanthropy into their practice, they're also that's a retention strategy, really not a nice to have, right? So I look at these advisors that are ignoring the charitable giving conversation, and they need to have that in that conversation because ultimately they're leaving AUM referrals and multi-generational relationships on the table. And the bottom line is that the facts are that clients who give through their advisors stay with their advisors. It's pretty simple. The number two I'd look at is, private foundations are not just for the ultra wealthy. Lou laid that out pretty clearly. That 5 million threshold is really a myth. With the right partner, a client with $250,000 in charitable intent can establish a private foundation and keep those assets under the advisor's management. That's probably a conversation most advisors haven't had. And even, smaller numbers, 10,000, whatever that may be, that can be woven into customer work. And then finally, I look at, the great wealth transfer is a philanthropic transfer too. We've seen a lot of money move in the last 2 decades. I think it's an estimated 84 trillion will change hands between, the next 2 decades, 84 trillion will change hands between generations. That's a significant portion of money. So, advisors who aren't part of that conversation won't be a part of the relationship. So those are the 3 takeaways I took. Did you have any additional thoughts?
No, basically my takeaway was what I said just before you started your takeaways.
All right. So in closing, what a great conversation with Lou today. I learned philanthropy is not a sidebar. It's really a growth strategy that most advisors haven't figured out. And those who have been pretty successful with it. So that's a wrap. But as always, before I leave, to quote Ted Lasso, be curious, not judgmental. This is Chip Kispert wishing you well until our next edition of BPN Insights.
Excellent. Thanks, Chip, and thank you for checking out the BPN Insights podcast, which is brought to you by Beacon Strategies, LLC. For more information, visit beaconstrategiesllc.com. Until our next BPN Insights podcast, for Chip Kispert and everyone at Beacon Strategies, I'm RJ Malik.